Thank you everyone for coming today to this lunch for the Global Value Fund. With you today from Global Value Fund are my two CIOs, Mark Ambrose and Miles Stouty. Mark is over from London and Miles is over from Sydney. And I am Emma Davidson, the CEO of Stouty Capital, the manager. Today, in our time with you, we were going to cover four main topics. A quick update on GVF, what's been going on, how have we been going, the big picture, few words on that, not too many, because I'm sure you're all bored to death of the big picture. And then passive, active, private. We're going to talk about two tectonic changes that we think are taking place in the markets and that will continue to take place over the next couple of decades. And then if we have some time, maybe one or two case studies to go through. Okay, so let's get cracking. Many of you will know the Global Value Fund, but for those that are new, allow me to spend a few minutes just talking about who we are and what we do and how we've done over the last 11 years. The first thing that GVF looks for when making an investment is a discount. So that's our number one priority. Trading at a discount is when the share price of a company is worth less than the underlying assets that that company owns. Here in Australia, there are 100 or so such companies that have this ability to trade at a discount. Overseas, there are thousands of these companies, and the total size of the market that we look at is about $600 billion US. And these companies can be literally they can hold assets, anything from equities to bonds to real estate to hedge funds, private equity, you name it. There is companies out there that own all types of assets. So we go in to invest, and we look for one, the discount, and two, we look to diversify our underlying asset holding as much as possible. And so far, with 11 years doing this now, we're very proud to say that we haven't had a single down year in the 11 years that we've been going. There are only 7 other products in the Australian universe that can claim the same. The company... Oh, thank you. Thanks. I don't know why I'm saying thanks. Well done. Annualized returns after all fees and expenses have been 11% per annum since our IPO, and on a risk-adjusted basis, there is very little that has done better than GVF. Now that's a very big statement and a bit bold to say, but allow me a few minutes just to qualify that statement. I think most people will agree over the last 11 years that probably one of the best performing asset classes has been the equity markets. They're well above the long running averages, and if you look at the equity markets, here on the screen I've got the Australian ASX 200, I've got the S&P 500, and I've got the MSCI, which is the top 2,500 companies in the world. So I'm showing you Australia, the US, global, and I'm showing you those annualized returns for each. Australia has given us 9% per annum over the last 11 years. US shares 16% per annum over the last 11 years, and global shares have given us that 13%. These are well above the long-running averages for these indices. Now, we all know that only part of the equation is the returns that we get. The other, equally important, is the risk we took to get those returns. And the most common metric used in markets is the volatility of an index or an underlying or an investment. The volatility simply measures how risky, how much something goes up and down. And you can see here the volatilities for the ASX, the US, and globally. The highest volatility came from Australia with the lowest return, which is not usually the formula that you're looking for. To quantify this and to provide a quick reference number, the market refers to a Sharpe ratio. And the Sharpe ratio is simply the annualized return divided by the risk-free rate and the volatility to give you a quick reference number. The reference number basically tells you the quality of the returns that you've received. The higher the number, the higher the quality of returns. What you can see here is that the US have given us as investors the highest quality of returns. for the amount of risk that you've taken, you've received the best return for that. Then global shares, and lagging quite a bit is Australian shares. So we've taken a lot of volatility for comparatively not enough returns. Over the same period, GVF has run with annualized returns of 11%. The volatility has been 7.6%. And again, if you focus on that Sharpe ratio, noting the higher the number, the higher the quality of returns, you can see that GVF really has kind of done a really great job for investors. Now, a lot of people like to argue how to measure risk rather than argue about which ratio is best to use. I've also shown the Sortino ratio up here on the screen, and I've also run some correlation numbers for anyone who's interested in correlation and R-squared. But hopefully what you'll see from all the numbers is that GVF has really outperformed just across every metric that we've been going. And we're just very proud of that, and we're very happy that we've been able to pay that all back to you guys as investors. Just in terms of the share price, because let's be honest, that's the thing that matters to everybody. We launched at $1 for 11 years ago. That dollar is worth $1.35 today, and we've paid out 90 cents on the dollar that we had. So it's hopefully been a good experience for everybody. At